If you have a 401k, an IRA, or any retirement savings at all, what I'm about to show you in the next few minutes is the most important thing you'll watch this year. Not because I'm trying to scare you, because the law changed, and your account didn't get a warning label. Trump just signed legislation that rewrites the rules on retirement distributions, required minimums, and tax protection, and the people who adapt in the next 90 days will come out $17,000 ahead of the people who don't. The question isn't whether this affects you. It does. The question is which side of this you end up on. Let me walk you through what this law actually changed, because the headlines are either incomplete or misleading, and incomplete information on this topic will cost you real money. The legislation President Trump signed modifies 3 specific mechanisms inside the retirement account framework. Each one sounds technical. Each one is devastating if you are on the wrong side of it. Change number 1, the RMD age adjustment and its interaction with the tax bracket structure. The law pushes the required minimum distribution starting age from 73 to 75 for certain cohorts of taxpayers. That sounds like a benefit. And for high-income retirees with large accounts who do not need the money, it is a marginal benefit. For the average retiree with an IRA balance between $200,000 and $600,000, it is a trap. Here is why. Delaying RMDs means the account balance continues to grow, but it also means the IRS deferred income compound problem gets worse. When distributions begin at 75 instead of 73, the IRA has had 2 more years to grow. The RMD calculation at 75 produces a larger distribution. That larger distribution pushes the retiree into a higher bracket. It increases their provisional income for Social Security taxation purposes, and it frequently crosses the IRMAE Medicare premium threshold, creating a Medicare surcharge that costs $629 to $4,748 per person per year, depending on income level. The retiree who thought they were getting a gift at 73 discovers at 75 that they are paying more in taxes and Medicare premiums than they ever paid before. Change number 2, the inherited IRA acceleration rule. The law modifies and tightens the 10-year rule for inherited IRAs that was originally introduced under the Secure Act of 2019. Under the new provision, non-spouse beneficiaries who inherit a traditional IRA from a retiree who had already begun taking RMDs are now required to take annual distributions during the 10-year window, not just a lump sum at the end. The IRS finalized the interpretation of this rule in late 2024. The new law codifies it and adds enforcement teeth. For any retiree who plans to leave their IRA to an adult child, a grandchild, or any non-spouse beneficiary, this change means the tax bill your beneficiary faces on your IRA is now larger, faster, and more predictable, and almost certainly larger than what you built your estate plan around. Change number 3, the qualified plan rollover restriction tightening. The law adds new documentation requirements and timing restrictions on rollovers from employer-sponsored plans, 401ks, 403bs, 457 plans, into traditional IRAs. Specifically, it tightens the 60-day rollover window enforcement and adds an automatic withholding provision that captures 20% of any indirect rollover at the point of distribution. This is not new. The 20% withholding on indirect rollovers has existed for decades. What is new is the enforcement mechanism and the reduction in hardship exceptions that previously allowed retirees to appeal the withholding. For any retiree who is considering moving money from an employer plan to an IRA in the next 12 months, the rules just got tighter and the cost of a procedural mistake just got higher. 3 changes. Each one sounds bureaucratic. Each one costs real money when the retiree does not know it is coming. And almost no retiree in America has been told what any of them mean in plain English. Now let me walk you through exactly why 97% of retirees will lose money because of this law. Not because they are not paying attention, but because the system is not designed to tell them. The first reason is what I call the delayed recognition problem. When a law changes the RMD age from 73 to 75, the average retiree who is 71 today does not feel it. They do not feel it at 72, they do not feel it at 73, because at 73, the old law would have required a distribution and the new law does not. They feel it when they are 75 and the first RMD is significantly larger than it would have been under the prior rules, pushing them into a higher bracket and triggering an IRMA surcharge they were not planning for. By the time the damage registers, the planning window is closed. The 97% retiree discovers the problem in the year it becomes unavoidable. The 3% retiree repositions 2 years before it becomes unavoidable. The second reason is preparer dependency. Most retirees rely entirely on a tax preparer who files returns, not a proactive planner who models forward. A tax preparer who is excellent at filing your 2025 return has no incentive and often no framework to model what your 2027 tax picture looks like under the new RMD schedule. They look backward by training. Planning against a new law requires looking forward. That is a different skill set, and most retirees are not paying for it. The third reason is the illusion of simplicity. A law that raises the RMD age sounds simple. Good news: later distributions, less complexity. Most retirees hear that framing and stop reading. They never get to the part where the larger deferred balance creates a larger RMD, a higher IRMA surcharge, and a steeper inherited IRA tax bill for their children. The simplification of the headline is the mechanism through which the trap is set. The fourth reason is that the $17,000 opportunity hiding inside this law is only accessible during a specific planning window, and that window is not advertised. It exists at the intersection of the QCD provision, the QLAC election, and the new RMD age structure. A retiree who repositions their IRA correctly in the next 30 days can use the law's own structure to generate a net benefit of $17,000 or more. A retiree who waits until the new rules are fully in effect loses the repositioning window permanently. Now let me walk you through exactly where the $17,000 comes from, because this is the part almost no retiree has been told. The opportunity exists because the new law created a 2-year gap between the old RMD age of 73 and the new RMD age of 75. For any retiree currently between the ages of 70.5 and 74, that gap is a planning window. Inside that window, a retiree can execute 2 specific IRS-authorized strategies that reduce their taxable income, reduce their Medicare premiums, and lock in a compounding tax advantage before the new higher RMD amounts begin at age 75. The first strategy is the Qualified Charitable Distribution, the QCD, under Internal Revenue Code Section 408D-8. A retiree who is age 70.5 or older can direct up to $105,000 per year directly from their IRA to a qualified 501c3 charity. That amount is excluded from gross income entirely. It does not count for Social Security taxation purposes. It does not count for IRMA threshold purposes. It does not appear on line 4B of Form 1040 as taxable income. For a retiree whose income currently sits above the IRMA threshold of $103,000 single or $206,000 married, a QCD of $14,000 to $18,000 can drop them below that threshold, saving $629 per person per year in Medicare, Part B premiums, and eliminating Part D surcharges. The second strategy is the Qualified Longevity Annuity Contract, the QLSC, under Treasury Regulation 1.4.11A 9-5 as modified by the Secure 2.0 Act. A QLAC allows a retiree to move up to $200,000 or 25% of their IRA balance, whichever is less, into a deferred income annuity that is completely excluded from RMD calculations until age 85. Under the new law's RMD age of 75, a retiree who executes a QLAC now locks in a reduced RMD base for the entire period from 75 to 85. That is 10 years of lower mandatory distributions, 10 years of reduced taxable income, and 10 years of potential IRMA threshold management, compounding annually. When both strategies are executed together in the same planning year, the combined benefit for a retiree earning $55,000 to $90,000 annually from all sources, with an IRA balance between $250,000 and $600,000, lands between $14,000 and $19,000. The midpoint is $17,000. That is the direct tax savings, the Medicare premium reduction, and the Social Security provisional income improvement, combined for a single planning year. The cumulative benefit over 5 years for a retiree who executes this correctly now is over $70,000. That is what is inside this law for the retiree who knows where to look. And almost no retiree has been told it exists. To make this real, let me tell you about a retired school administrator named Dorothy. Dorothy is 73 years old. She lives outside of Pittsburgh, Pennsylvania. She spent 36 years working in the administration of a public school district, assistant principal, then curriculum director, then district administrator. She retired in 2019 with a state pension of $2,200 per month and a traditional IRA with a balance of $428,000 that she had built through voluntary contributions over her career. Her total annual income going into 2026 was $26,400 from the pension, $21,600 from Social Security, and $15,600 in required minimum distributions from her IRA. Total $63,600 per year. She used the same tax preparer she had used for 11 years. She paid her Medicare premiums on time. She had never heard the term IRMA. When Trump's legislation passed, Dorothy's neighbor, a retired accountant named Frank, mentioned over the fence that something had changed with retirement accounts. Dorothy called her tax preparer and asked if there was anything she needed to do. Her preparer told her the law had pushed the RMD age to 75 for some people, that it probably did not affect Dorothy since she was already taking RMDs, and that there was nothing she needed to do right now. That answer was not wrong. It was incomplete. What Dorothy's preparer did not explain was that under the new law's interaction with the IRMA thresholds, Dorothy's income in 2026, unchanged from prior years, now sat in a zone where a single strategic action could reduce her federal tax bill by $3,400, eliminate her Part B IRMA surcharge of $629, reduce the taxable portion of her Social Security by $4,200, and establish a QLAC that would lower her RMD-driven income for the next 12 years. Total first-year benefit if Dorothy acted, $16,900. Total 5-year benefit, approximately $68,000. Dorothy did not act. She trusted the incomplete answer. She filed her 2026 return in April 2027 exactly as she had filed every prior year. She paid $3,400 more in federal income tax than she was legally required to pay. She paid the IRMA surcharge she was legally entitled to avoid. And she will pay both again in 2027 and 2028, and every year after that until someone gives her the complete answer. Dorothy's story is not about negligence. Dorothy is a sharp, organized, financially responsible person. Her story is about the gap between a preparer who files returns and a planner who models outcomes. That gap cost her $16,900 in the first year alone. It will cost her $68,000 over 5 years. And it will cost hundreds of thousands of retirees exactly like her the same amount. Not because the opportunity did not exist, but because almost no retiree in America has been told where it is. Now let me walk you through the 4 most dangerous misunderstandings retirees have about this law, because each one is costing real money right now. Misunderstanding number 1. The higher RMD age is a pure benefit. It is not. For high-income retirees who do not need the income, the deferral is marginally useful. For the average retiree with a $200,000 to $600,000 IRA, the deferral means 2 more years of tax-deferred growth, followed by a larger RMD at 75 that pushes them into a higher bracket than they planned for. The retiree who assumes the later RMD age is automatically good news and takes no action is the retiree who discovers at 75 that their distribution is $4,000 to $8,000 larger than projected, and that it crossed the IRMA threshold they could have avoided. Misunderstanding number 2. The inherited IRA change only matters when you die. It matters right now, because your estate plan was almost certainly built around assumptions that are no longer correct. If you plan to leave your IRA to an adult child who would stretch distributions over their lifetime, that plan was already modified by the Secure Act of 2019. This law tightens it further. If you have not reviewed your IRA beneficiary designations and your estate plan with an attorney who understands the current inherited IRA rules, you are operating on assumptions that could cost your family tens of thousands of dollars in avoidable taxes. Misunderstanding number 3. Rollovers from employer plans are straightforward. They are not. The new documentation requirements and the tightening of the 60-day rollover window mean that a retiree who makes a procedural error during a rollover, takes the check, does not complete the deposit within 60 days, or fails to document the transaction correctly, can be treated as having taken a fully taxable distribution. At a 22% tax rate on a $100,000 rollover, that procedural error costs $22,000. Always use a direct trustee-to-trustee transfer. Never take possession of the funds during a rollover. This rule predates the new law, but the new law adds enforcement teeth that make the consequence of a mistake more severe. Misunderstanding number 4. You have time to figure this out later. You do not. The planning window that allows the QCD and QLAC strategies to interact optimally with the new RMD age structure is open right now. Every month you wait is a month the compounding advantage shrinks. A retiree who acts in May 2026 captures 10 years of QLAC RMD reduction and the full 2026 QCD income exclusion. A retiree who acts in December 2026 captures the QCD income exclusion but loses most of the QLAC coordination benefit. A retiree who acts in 2027 has missed the 2026 planning year entirely. The law is not going to remind you of the deadline. Almost no retiree has been told one exists. Here are the 5 protection moves every retiree needs to take in the next 30 days because of what this law just changed. Protection move number 1. Calculate your current annual income from every source: Social Security, pension, IRA distributions, any part-time work, any investment income, and compare it to the IRMA A threshold of $103,000 for single filers or $206,000 for married filing jointly. If you are within $20,000 of either threshold, you are in the highest priority group for the QCD strategy. The IRMA A savings alone, before any income tax reduction, can justify the entire effort. Do this calculation today. It takes 15 minutes and a copy of your most recent tax return. Protection move number 2. Call your IRA custodian and ask 3 specific questions. What is my projected RMD for 2026? What is your internal deadline for QCD submissions? And do you offer QLAC products, and which carriers do you work with? Write down the name of the person you spoke to and the date. These 3 answers tell you everything you need to know about your planning window. Protection move number 3. Review your IRA beneficiary designations today. Log into your IRA custodian's online portal and look at the primary and contingent beneficiary fields. If your beneficiaries are adult children or grandchildren and you have not updated your designation since 2019, your estate plan is operating under rules that no longer fully apply. Contact an estate planning attorney who specializes in IRA distribution law, not a general practice attorney, and have them model the tax impact of the new inherited IRA rules on your specific account balance and beneficiary situation. Protection move number 4. If you have money in a 401k or employer plan that you are planning to roll over to a traditional IRA, initiate a direct trustee-to-trustee transfer immediately. Never take a distribution check with the intention of depositing it into your IRA within 60 days. Under the new enforcement provisions, the margin for error on indirect rollovers is now 0. One missed deadline, one processing delay at the receiving institution, one administrative error means a fully taxable distribution. The direct transfer method eliminates that risk entirely. Protection move number 5. Before the end of this week, call your tax preparer and say specifically, I need to discuss how the new RMD age change interacts with my IRMA A exposure and whether a QCD and QLAC strategy makes sense for my 2026 income picture. Can we speak this week? If your preparer cannot answer that question in detail, find a CPA or enrolled agent who specializes in retirement income planning. A 1-hour consultation costs between $150 and $300. The benefit of acting on the right advice before the planning window closes is $17,000. Now let me share the bonus move that almost no retiree in America has been told about, and that multiplies everything else I just described. It is the Roth conversion ladder positioned inside the new RMD age gap. Here is what almost no retiree has been told. The 2-year window between the old RMD age of 73 and the new RMD age of 75 is the single most powerful Roth conversion opportunity most retirees will ever have. During those 2 years, for any retiree currently between 70.5 and 74, there is no mandatory distribution requirement under the new law. No forced taxable income from the IRA, which means a retiree can choose exactly how much to convert from a traditional IRA to a Roth IRA each year, filling their current tax bracket deliberately without being pushed into a higher one by a mandatory distribution. A retiree in the 22% bracket who converts $20,000 per year from a traditional IRA to a Roth IRA during the 2-year gap pays $4,400 in tax now on those conversions. But every dollar in the Roth account grows tax-free permanently, is never subject to RMDs, and if left to an adult child as an inherited Roth IRA, is distributed to that beneficiary income tax-free over the 10-year inherited IRA window. Combined with the QCD and QLAC strategies I described earlier, a retiree who executes the Roth conversion ladder inside the RMD age gap, funds a QLAC to reduce future mandatory distributions, and uses QCDs to manage current income can potentially reduce their lifetime tax burden by 6 figures over a 15-year retirement horizon. That is the bonus move, not a separate strategy, a multiplier that compounds everything already in motion.